Good morning. I'm Greg McKenna. It's Friday, the 11th of September, and here's your market wrap of all the overnight news and views. Got a bit of a flu today, so I'll be a bit slower. Maybe that's a good thing, and maybe a bit hoarser. But it was an interesting night overnight, and sometimes you feel sorry for European traders. Mostly I do. They're always a day behind. Today they're down when the US is up. Yesterday they were up when the US is down. They're always catching up and all that kind of stuff. Of course, some people might say that European stocks came under pressure because of the Brazilian downgrade by S&P to junk, but realistically, S&P and Moody's and Fitch are really irrelevant when it comes to real companies. The fact that they've downgraded the credit rating of Brazil will already have been felt by any companies doing any business in Brazil, and they're not necessarily a reflection of the experiences those companies are having. And they certainly won't be a revelation to the stockholders, or certainly the management of those companies. Certainly shouldn't be anyway. But anyway, so we ended up with European stocks lower. But at the close of business, US markets are up. The Nasdaq Composite was up 0.84% to 4,796. The Dow was up 0.5% to 16,330, and the S&P was also up roughly 0.5% to 1952. Markets in the US, they're still in that wedge pattern. We've still got our nice top, and we've still got our base forming up. Can't expect too much action within, I'd expect a tightening of that wedge. We've got a whole week that we have to wait for this FOMC meeting. So some kind of head fake either way might actually happen, but it's going to be a dangerous few days for traders in Asia. We've got the States tonight, obviously, one more trading day for them, and Europe, and then we've got 4 whole trading days, so Monday, Tuesday, Wednesday, Thursday next week to get through before at 4 o'clock Friday morning we're going to have the FOMC announcement. So that's really going to be interesting. But at least the impact of the S&P rally last night and the rally more broadly in US stocks is going to be that we're expected to have a better day on the ASX today. As you know, I'm a trader. When I say better day, people just feel better when stocks go up. I'm indifferent. If the market's going up or it's going down, hopefully I've got the position that the market's told me to have and which suits that. But in general, people feel better. So it's always good to see stocks go up. Prices go from bottom left to top right. Your equity curve goes from bottom left to top right. That's what you want to see. You want to see that kind of growth and that sort of thing. But anyway, so the other thing that's going to help the Aussie market is that crude bounced another 3%. It reversed that big sell-off the day before. We saw that demand's increased from the Energy Agency last night. That flows on from the other report, which showed that there was 140,000 barrels less produced in the States in August. So those two things together have got oil back up at 45.60 in the front contract. Iron ore's continuing to rally sharply as well, which is going to be a good thing for the Aussie miners. And of course, the technical setup in Aussie banks, I think, looks pretty good. Yesterday would have been another retest of those recent lows. So if they can hold, we could get some another strong bounce. But realistically, we're still waiting. We're still trading a range on the ASX. We're still waiting on where the FOMC this week. On Forex markets, the Bank of England put the cat amongst the pigeons by saying that even though there were headwinds, they needed to focus on the domestic economy. That's something I'd encourage the Fed to do. I think that 0% interest rates are completely incompatible with where the US economy is, 5.1% unemployment. And I agree with SocGen's Albert Edwards, who put out a piece which you can find on Business Insider. It's the one on the homepage with the clouds. You'll find it. He basically said that there's one thing worse than global deflation. If I can quote Edwards, even those like me who see the deflationary bust awaiting think the Fed should hike next week, because the longer you leave it, the bigger the financial market excesses become, and the bigger the risk of financial dislocation and global recession ensuing. Have we learned nothing from the 2008 Great Recession? Just get on with it. I agree 100%. Get off the pot. One and done, which is what we've been talking about. There's nothing wrong with going one and saying you're going to see how things turn out. That's what the Reserve Bank of Australia would do, the best central bank in the world, I think. And that's what the Fed needs to do next week. One and done. Give it to the market, let them react. 5% fall, 0% fall, 2% gain, who knows? But get it over with, because Edwards is right. Each time you delay because the market goes into a funk, means that the risk is that at some point they're not going to have a choice. What happens if unemployment goes to 4.9%? You know, in my Business Insider 20 seconds report, which I'd encourage you all to have a look at, because I don't get to cover everything I talk about here. Two articles that caught my eye today. It's never taken longer for US businesses to fill a job opening, and CFOs still can't fill positions fast enough. That means they're hiring more. Now, those headlines are kind of counter, but they mean the same thing. The US economy is doing better. Wages are going to start rising. Money is going to start rolling through the economy. Now, I'm with Edwards. I don't think there's necessarily an inflation pulse coming anywhere on the planet for the next little while. But Fed needs to raise rates. Speaking of employment and raising rates, 17,400 in employment yesterday in Australia. Fantastic result. The Aussie dollar's up as a result after getting flogged lower as traders look for liquidity when they couldn't get enough in the Kiwi yesterday. That drove us down to around the 69.40 mark, but we're 130 points higher in the Aussie now at 70.70. It's in that zone that, if I may, let me just find my chart, sorry. It's in the, I'll just share the screen with you. It's in the place where I would normally lighten my load, take about 50%. So the way I trade, you can see, I look at trend lines because everyone else does, they work. You know, I disagree with people who say you shouldn't look at trend lines. I think that's ridiculous. You know, back here I said it was time to buy. Rallied up to here. It always, not always, but generally, it has some sort of pullback off my fast moving average. If we can get up through this 70-80 region, call it 84, we're going to rally a cent, and we're going to be up here. Now, whether it can get back into that old trend line, it's be a bit like oil, and it might pull back. You know, it's a positive outlook for the Aussie. And whilst it's natural for me to have taken back some of my posse, that's just the way I trade. The rest of it will get a run. Speaking of oil, that's not oil. That's the S&P. You can see here a nice basing pattern. These are ugly, aren't they? Something's going to happen here. Something's got to give. But if you have a look at, there's a nice flat bottom here, and maybe the top. Maybe we are going to break to the top side. I'm certainly happy to be long with my stop under this low from a week or so ago in oil. Now, what does that tell me? If oil goes up, that's going to help the ASX. That's an environment probably where the Aussie's doing well. But we'll have to see. Now, at the moment, we've got the prospect of a trade on a break, or the prospect of a break higher. As I said, I'm happy to be long with a stop below the recent low, but nothing has actually happened yet. In terms of the data today, there's nothing really out. One thing I did want to highlight, I wrote an article yesterday where Peter Jolly from the NAB rebutted 7 reasons why the Australian economy is doing much better than Paul Krugman and other doomsayers are saying. I'd encourage you to have a look at that if you haven't already read it. And then David Scutt, my colleague from Business Insider, yesterday wrote an article just highlighting the Australian economy is working in all the right places. I've got the links to those in my 20 seconds piece at Business Insiders if you want to have a look. So that's pretty much it. It's going to be a better day in Asian trade today after the Nikkei fell 2.5%. Let's just have a quick look. I haven't got a Nikkei chart on Go Markets, but the Nikkei has bounced this week off the Abenomics uptrend. Keep your eye on that. Unless or until it breaks, it should be okay. So I'd expect that to take back some of the losses it saw yesterday. On the data front today, nothing important on the calendar in Australia. South Korean Central Bank the Bank of Korea is due to announce its monetary policy decision. In China, we're still waiting on new loans, and tonight in Germany, CPI. In the US, it's producer prices. So good trading. Remember, keep your volatility and your position size relative to what's happening in the market. That's what I do, and that's what's always served me and certainly other traders I know well. It's Friday morning, so I won't be back till Monday, but have a great weekend. And next week we can all get ready for 4 days of pre-FOMC trading. Have a great weekend. I'm Greg McKenna. Bye for now.